News.
For more, we're joined in our studios by Charles Chaw. He's the director from China Knowledge. It seems investors are running scared with this new development, with a slew of non-tradable shares being flooded into the market.
I guess the pessimism of the downfall on the first day of trading on Monday of about 2.44%, also the 6-year low, is the market perspective from the public. But longer term, what I see is a bold step by the government to increase liquidity. And that is a very important step before they allow A shares to be traded to foreigners.
But the big issue here is that none of these major companies are still being offered to the public, but basically mid-cap issues, for example, Sany Heavy, Shanghai Zhejiang, Xinhua Tongfang, and Hebei Jinhua. Is the government really committed in seeing these through?
This is a pilot project, so they started with 4 mid-cap stocks, which is a wise move, and it's a testing. And if it's well received and the stocks perform as it is expected, then follow on will be bigger market cap stocks coming into the market.
But if the stock market continues to plunge even further, there was even a survey here, 40% expected a sharp decline of the stock market, while about 25% expected a sharp rise of the stock market. If the negatives outweigh the positives, is there a likelihood that the Chinese will back off from this move?
Yeah, the 40% respondent feels that the market would fall when the market opens. It's from the perspective of public investors in China. Longer term, if foreign investors are allowed to buy A shares and the local shares, the increase in liquidity of most stocks would in fact would boost up the market. Now, if you look at Chinese stock market, like the Shanghai Composite Index, the PE ratio is 18. That is equivalent to London Stock Exchange, Dow Jones, and compare that to maybe Hong Kong 16 times. I think at this level of 18 times PE is a very reasonable price, reasonable level to go into such a hot economy.
As you say, in this pilot scheme, only 4 mid-cap stocks are being introduced to the market, and that's already creating a lot of turmoil in the Chinese stock market. What about the big-cap stocks like Sinopec, Unicom, or Bao Steel? When will their non-tradable issues, in your view, start flooding into the stock market? When will it happen?
It's just a matter of time, but from our views, it probably requires 2 to 3 years, knowing that the Olympics is coming 2008, and then there's a rumor or there are plans, I think, by the central government to allow the renminbi to free flow. So these are all add-on, in fact, to the advantage of the stock market.
And how will the revaluation of the yuan affect the stock market and the trading of these non-tradable shares going forward?
Today, we see a lot of hot money going to China, and most would claim that they are investing into the China stock market, which we're not seeing a lot of this cash buying the stocks. But they're waiting for the appreciation of the renminbi. So the hot money coming to China has many ways of benefit from such
Such a move. All right, Charles Chaw, director from China Knowledge. Thank you so much for joining us.